Your market news now. Internet group NestPass and its investment arm Process, which owns 26% of China's Tencent, will unwind a complex set of shareholdings in each other that had threatened to impede stock buybacks funded by sales from the Chinese tech group's shares. The announcement sent both the shares of the companies up almost 10% in early trade. The companies also reported full-year earnings, which showed a fall in profit due to lower earnings in China's Tencent, in which again Process owns a 26% stake. Meanwhile, coal miner Exaro Resources say it expects production and sales to decline in the first half of the year due to lower domestic demand, while persistent rail logistical problems continue to hobble exports. The miner, that is valued at 57.2 billion rand on the JSE, is a diversified resources company with interests in coal, iron ore, and renewable energy commodities. The miner will publish its interim results on August 17th. To talk to us about the latest when it comes to the markets, we are joined by Makwe Masilela from Makwe Fund Managers. Makwe, thank you so much for your time. Before we get into the other aspects, the company news that I mentioned a bit earlier on, let's talk about market sentiment right now, given that investors are quite concerned that we have central banks here who are hell-bent on fighting inflation, which could tip some economies into a recession.
Yeah, and you are right. Today the European Central Bank president made it very clear, it was loud and clear, that listen, interest rate hiking cycle is not yet over. And also we had the likes of the IMF also stating that inflation continues to be just far above the targets. So as a result, central bankers have to continue to increase interest rates in order to fight all that, and regardless of what is happening with the economies. So as it stands now, I think we all now factored in that interest rates will stay high for longer. And we know the negativity when it comes to equities, and also the comments that we also had last week from the US Fed when he was making his testimony.
So let's talk NestPass and Process. And I know we've got both the charts for our viewers on a 3-month view, given the announcement that they put out on SENS saying that they're going to be removing this cross-holding structure. Let's unpack it here for the viewers who may not necessarily understand what has been going on, at least here for the past couple of years, the rationale of the structure in the first place, and why investors were quite negative about it.
Remember, people tend to forget, and hence we are not factoring in the equities or the investment that NestPass hold, that they've got the likes of Takealot, the likes of Mr. D, Auto Trader, but unfortunately they're not reflecting on their pricing, because all along Process has, Tencent, which the guys at some point were owning more than 30%, is the one that has been reflecting. And as a result, we see that as we are talking, NestPass is valued at almost 1.3 trillion on the JSE, Process around 2.5 trillion. But now, to fight that way of NestPass on the JSE, investors were made to swap their NestPass shares for Process, and we know they've got the share buyback program, but unfortunately SA company law doesn't allow a subsidiary to buy more than 10% of their holding company, and the guys there are just about to reach that, so they don't have much of a choice but to unwind that cross shareholding that they've been having. And we know the Reserve Bank are happy with that. They just have to get the approval from the shareholders going forward. And also investors were not too happy, saying that is not good when it comes to the intrinsic value of the whole thing. As we are talking now, we can see that NestPass, they've managed to reduce that discount when it comes to their share price by almost 18 basis points. They've got a discount of almost 55%, which is still quite high. Ever since, NestPass has been struggling to try to make sure that they close that discount when it comes to their share price and what is the value of this whole thing. So it's a nice problem to have, I guess, for them, because even for them to create the likes of Process was to fight at the very same discount.
Right. So let's move on to Exaro as well. They're going to be releasing their results on August 17th, and we'll look at the Exaro chart right now, the 3-month chart. Here again, it's the rail bottlenecks that are continuing to get worse, having an impact on them. What's the concern here for you, given that the market, if you look at where it's trading, it's down 3.4% right now?
And for the past 6 months, it's down almost 26%. And yes, we know that the guys are paying a very good dividend. But unfortunately, it's not only shareholders of Exaro which are losing out because of Transnet issues. The economy itself is losing just under $1 billion a day because of the rail issues. And we've been seeing with Exaro as well. They were impacted by less demand that was coming out of Eskom. And hence, we see their production was down almost 4%, sales volume down 7%. But also looking to the coal price, I mean, they expected to receive an average price which is going to be 52% or so less than what they received in the previous 6 months.
Your view on the general SA equity market?
Not looking great, and unless if what was said this morning from Beijing, that they are prepared to take extraordinary measures to help the economy, and they expect the economy to grow much better in the second half, and that's after a day when we've seen the S&P cutting their economic growth forecast for China. So if China managed to get it right, then probably it might start to lift other economies, because so far we've been disappointed by that reopening of the Chinese economy. We thought that it will do great, but so far what we've been seeing is the uneven recovery. So as it is now, it's not looking that great.
As we go into the second half of the year, given the current environment, have you changed anything when it comes to your investment thesis so far?
Yes, for the fact that it's loud and clear that interest rates will continue to go up, then it's worth looking into your bonds, because if you look into the yield that we're getting, I mean the one that expires in December 2026 for South Africa, we're getting a yield of almost 8.5%.
Before I let you go, what do you think will be a driver of markets in the second half of the year?
The economic recovery and the interest rates which are going up, and we've seen that what we are having now is not is the disinflation, meaning prices will continue to go up, but at a slower pace.
All right, Makwe, thank you so much for your time. That is Makwe Masilela from Makwe Fund Managers. And the other thing we're going to be keeping an eye on over the next couple of days is that central bank meeting that is happening in Spain, where the heads of the major central banks will be hosting a panel with investors, keeping a close eye on some of the details that come out of those discussions, and as it relates to what the inflation picture could look like for the remainder of the year, or whether we could actually see higher for longer. However, that is it from me. We're going to take a quick break. When we come back, we'll have more news for you, so stay tuned.